Hey, what it do, world? Welcome to the Market Banter Podcast. I'm your host, Dion Rabowen. I'm a financial journalist, write the Axios Markets newsletter. With me, as always, he's grinning, he's smiling because he knows that he is the inimitable, the irreplaceable. He's New York City comedic legend, Dan Enfield. He's with me on the show right now. What's going on, Dan?
How's it going? How are you?
I'm doing all right. Man. It's been an interesting week.
For sure. There's no breaking news during this show so far, like it was last week. So.
Yes, no breaking news happening whatsoever that you didn't already hear about yesterday.
You should really get one of those flash buttons on the bottom of the screen,
Yeah, it says no breaking news because
we
record this a day before it goes out.
Yeah.
So anyway, we have a fantastic guest on the show, the big homie, Gregory Daco. He is chief U.S. economist at Oxford Economics. He is on the show today. He's going to be talking with us about the jobs report, labor market, talking about the state of the U.S. economy. We talk about basically the way that stock market valuations have gotten away from the real economy and what that means. And I also asked him, okay, so if the stock market and the real economy are just completely separated and not related to one another anymore, why do people need economists? And I thought he did a pretty good job answering that. Dan, how you doing?
I'm doing great, man. Just trying to make sense of everything right now, like everybody else.
Yeah. There's a lot to make sense of with this. You got this whole impeachment thing happening. Apparently, the House is going to impeach the president again, which is interesting. It's oh wow, is that what they're doing? Yeah. So this is really, I don't know what it means to get impeached twice. I guess it doesn't really mean anything because
has that ever happened before? Or?
No, I don't think it's ever happened before. Mitch McConnell, who's the Senate Majority Leader, has said that he's not going to hold the trial in the Senate to convict him before the inauguration of President-elect Joe Biden, which means that the impeachment vote is largely symbolic. But it kind of was that anyway, right? Like the guy's got a week left. So,
who was it? Hey, Archie Manning won the Heisman twice, right? So,
yeah,
it's an accomplishment to get it twice, right?
Yeah, that's one way to put it.
Yeah.
So I want to get
twice, yeah.
Wait, what was that?
I think he was the only guy to win the Heisman twice.
He was the only guy to win it twice. Tim Tebow almost won it twice, but he didn't.
Right.
I think Tebow's the only guy to be nominated 3 times.
Oh wow!
Or make it to like the final whatever that goes to New York 3 times.
Right.
So,
that's a fun fact.
There you go. Yeah, fun fact. So actually, I want to jump right into our interview with Gregory Daco. I thought he had some really interesting thing to say. Dropped a bunch of knowledge on us. Dropped a bunch of science. He had some dope headphones as well that look like those legit 70s headphones that you used to have to wear. With like the kind of metal thing that goes around the top. I thought they were fly. So anyway, our viewers who are watching us on video will get to see that. And we go now to our interview with Gregory Daco, chief U.S. economist at Oxford Economics. Welcome in Gregory Daco. He is the chief U.S. economist at Oxford Economics. Gregory, sir, how are you? Thanks for being with us.
Very well, and you? Thanks.
I'm doing well. Look, I think we got to start talking about this jobs number that we got on Friday. The market clearly didn't care, kept going up, but the market doesn't seem to care about anything these days, at least anything negative. But what was your take? Because there was certainly a lot of on the one hand, on the other hand, that you economists did with this report. What was your take?
Well, I think overall it confirms the situation in terms of the broader economic situation, which is one in which we've seen quite a significant slowdown in economic momentum towards the end of 2020, and the handoff into 2021 is actually fairly soft. This first contraction in employment since the start of the recovery is an indication that indeed we are going to start this year with very little forward momentum in terms of employment. And that's just broadly reflective of a health situation that's deteriorated, mobility that's slowed, and overall demand that's a little bit more hesitant than it was at the end of last summer.
Dan, jump in.
Do you guys foresee that improving as the vaccines and things like that get distributed?
Yeah, I mean, I think overall we do expect an improvement in the overall economic situation, both in terms of output, in terms of consumer demand, in terms of business activity, and in terms of employment. We are only partway through this recovery, and we're entering what I would call a fragile phase of the recovery. We still have nearly half of the jobs that we lost to recoup and to get back to where we were pre-COVID. So that's a fairly deep hole to dig ourselves out of. But we are optimistic about the medium term. The advent of the vaccine and the distribution that is gradually improving and gradually increasing should support reduced virus fear and should also support an environment in which consumers and businesses feel more comfortable, more at ease to spend. So as we look into the second half of 2021, I think we're likely to see stronger growth. We're likely also to see consumers that have a fairly large stash of savings use those savings to spend, and we're likely to see still some fairly positive fiscal stimulus with a Biden agenda that's likely to be put in place in the coming weeks.
You're saying there's pent-up demand that people want to go out and start doing stuff.
We're all eager to go out and spend, especially on the service sector side. What is one of the paradox of this recession is that we essentially saw a massive cutback on service sector activity. That's not surprising at all. But at the same time, we saw a fairly rapid rebound in spending on goods. People that were stuck at home essentially were able, in part thanks to a fairly large fiscal stimulus program, were able to spend on goods and order online things that would improve their day-to-day activities. So we saw this strong rebound in goods sector, but the service sector remains quite depressed.
Right. So Greg, let's just take a step back here because, as we were going into this crisis, I talked to a lot of economists, and really what the diagnosis I'll say was, well, as long as we don't have a bad second wave, as long as the jobs market continues to improve, as long as this and that, and basically everything that they said would be a worst possible scenario has happened, and we've still seen the stock market just continue to sky, grow to all-time highs. But I think also, too, there seems to, obviously we have the vaccine now, but the rollout has been much slower than a lot of folks expected or would have hoped for. I just wonder, why do economists, and as you've said, I put you in this camp just based on your comments right here, why do they continue to look on the bright side? It seems to me now would be the time for a, worst case scenario outlook. Just given that it's gone about as poorly as it possibly could.
Well, I would push back a little bit against the fact that it's gone as bad as it could. We actually had a fairly large amount of fiscal stimulus that was pumped into the economy that prevented the worst case scenario. Both the actions of Congress, which acted very quickly with the CARES Act and with a very large degree of stimulus, along with the Fed support, I think provided this invaluable cushion that essentially prevented an even deeper recession and potentially a financial crisis on top of the COVID crisis that we saw. So in part, the rapid rebound that we saw in April, May, June into September was due to this fiscal stimulus program that helped support consumer spending, helped support business activity, and help us get back part of the way to where we were pre-COVID. In terms of the optimism, I would say we're fairly cautious about the outlook, but we're realist about what is needed to get to this brighter outlook. We have to keep in mind that it's not just a matter of growth in this environment. Growth is largely irrelevant in this environment because, of course, you're going to get strong growth because you're starting from depressed levels of activity. What matters is the levels of activity relative to where you were pre-COVID. And there, we think it's going to take some time. Just to give a few reference points, we still think it's going to take another 6 months for GDP, so overall economic activity, to recoup its pre-COVID level. We think it's going to take another 2 years for employment to regain its pre-COVID level. So it's going to be a slow recovery, but the growth rates are going to be very impressive. And even if you get, let's say, 2/3 of the population vaccinated by the end of June, which is still about 5.5 months away, that would allow you to get a stronger impetus in the summer and going into the second half of 2021.
Okay, I want to ask you a quick question about, everyone just asks, is the market disconnected from reality? And I think the obvious answer is yes, but if you feel strongly the other way, feel free to push back. But the question I'm really interested in from your perspective is, Bank of America came out recently and pointed out that the size of financial assets is 6 times the size of the economy right now. Do you see a danger in that, or is that something that worries you?
I think we have to be very cautious about the valuations on the markets front. The key question is what happens to earnings over the coming months. Do we see earnings rebounding and essentially catching up to valuations? Or do we see an environment in which that does not occur, in which case essentially you could continue to have a fairly strong disconnect between markets and the underlying economy? I think one of the key messages here, and we've learned this over the past 9 months, if it wasn't clear before, is that markets are not the economy. They're reacting to different types of factors that may be completely independent of how the average household may be feeling or actually spending. In particular, I think we have to be very much aware of the Fed's unusual and unusually dovish position when it comes to its policy stance, and the new framework that it has adopted, whereby it's going to be much more dovish than previously and wait until it sees inflation to tighten monetary policy, is a further support to the market's backdrop. I think if we were to see some tightening of financial conditions, I'd be very curious to see how much tightening of those financial conditions the Fed would tolerate before it signals further easing of monetary policy. So there is that strong Fed put that is likely to remain in place for the foreseeable future, and I think keep that disconnect between the economy and markets.
Dan, I feel like I see you nodding there, but I feel like I followed all that. Did you get all that?
I think I did. I think basically, if I could sum it up, it's going to be kind of staying how it is now in terms of like the market's going to keep going up despite what's going on outside. Is that
is that what you're saying, Greg? Buy the all-time high.
We generally don't advise on making these types of decisions. But from a broad perspective, I think there is that element that is present. The direction of travel in the near term is always very hard to predict. Who would have predicted that after the invasion of the Capitol, you'd see stock markets still rise? That was an unusual event, a very sad event in the history of the United States, and yet markets on that day actually rose. They gave back some of their earlier daily increases, but they actually rose, which would make no sense to an external observer if you're not conscious of the full backdrop. The Fed position that is quite supportive, quite dovish, and the expectations, and we haven't talked much about this, but the expectations of increased fiscal stimulus under a Biden administration now that the Democrats will have control of the Senate.
So let me ask you this really quickly, and this is a real question. I'm asking it sort of tongue-in-cheek, but this is a real question. I mean, if the market is just divorced from the economy, why should Wall Street firms pay, companies like Oxford Economics, for example, for their thoughts on the economy if, the two don't really go together anymore?
Well, I think where we add value in terms of the analysis we provide is not necessarily providing a base case scenario. Anybody can put out their thoughts on what the base case is going to be. I think you alluded to this earlier, but the idea of building scenarios around a baseline is really where we add value, where we provide value for businesses, because we don't only provide value to investors, we provide a lot of value to businesses that run across the gamut in terms of industries and sectors, and we allow companies to essentially be able to prepare for alternative futures. What happens if this scenario is more likely to take place? Around the elections, for instance, what would have happened under a new Trump term? What would have happened under a Biden term? Or what happens under a COVID scenario that is worse or better, as you alluded to earlier? So that is really where we provide added value, and that then in turn influences the path of the economy. And investors may care about that, because if you're not in some sectors which have done quite well, then there are tendencies to see strong variations. I think one of the key elements of the most recent market developments is the polarization. I mean, a few firms have really outperformed the rest. And then outside of that pack, there is quite a bit of volatility and variation that depends on the economic evolution of the different economies around the world and the different sectors around the world.
Yeah, Greg, last question I want to ask you, and maybe Dan will have a question after you finish this, but the last question I want to ask you is I've been writing a lot recently about this kind of backlash that the Fed has been receiving. I think last year, March, April, really all the way up through even October or so, the response from financial markets was, yeah, the Fed's rigged the game, but they did what they had to do. And of late, I've seen, whether it be Mohamed El-Arian of Allianz, to a number of the big names out there, really kind of saying, hey, actually, the Fed has juiced inequality, wealth inequality, income and wealth. The Fed has rigged financial markets and, taken out price discovery. And actually, this is a lot more bad than good. Where do you stand on that, and what do you think how do you think this impacts the Fed going forward?
Well, I think there's very much an intertemporal question or element to your question, in that we have to, assume that everything that has happened would have happened differently had the Fed not intervened. So I think the argument of the Fed having to intervene very early and doing so in a very rapid and very determined way helped prevent what could have been a financial crisis on top of the COVID crisis that we'd lived through. Now the question is, we're in the situation we are in today. How do we get back to a more normal situation where there is perhaps less of that perception of a permanent Fed put, and where it's going to be very difficult for the Fed to essentially escape this very dovish environment? And that requires a bit of a rethink about how to conduct monetary policy with a prudential aspect to ensure that we don't have these excesses taking places and bubbles forming that could spell trouble for the rest of the economy. It's a very, very difficult question, but I think we can't just assume that we are in the situation today where we are and that we could have been someplace else. I think we are in the best situation we could have been, given the elements we were given in terms of the COVID crisis. The question is, how do we navigate to a more normal and sustainable environment in terms of policy support? And that's a key question. That's not an easy one to answer.
It's not, but do you think the Fed is having those hard negotiations or hard discussions about actually getting out of this? Because from what I've heard from Powell and really the rest of them is they aren't.
Well, they are concerned, and this is something that's been highlighted by a number of Fed policymakers. They are very concerned about inequality. I think their annual or their year-long review was, well, I do think so. I think Powell has...
They say they are.
I would tend to think so. I mean, if you look at the new targeting framework, the inflation targeting framework that they've adopted, and the fact that they've put much more weight, an asymmetric weight towards inflation versus employment is I think key. They are willing, at least they've defined an environment, a framework, in which they are willing to tolerate essentially a lower unemployment rate as long as they don't see signs of inflation. That's a good sign. Whether it's credible or not, whether it will be put in place once we start to see lower unemployment.
Greg, but that's the question, isn't it? That is exactly the question. And we got to go. I appreciate you taking the time, but I think, to me, that's exactly the question. I think when they came out with this average inflation targeting thing, that was a symbol, oh, okay, the Fed is changing. But on this, where they've done this thing and they've really, like I said, juiced inequality exponentially from where it was, now they have nothing to say and they have no solutions to offer. And I find that to be interesting. But we've run out of time, and I apologize for taking up so much of it with my questions. Gregory Daco, Chief U.S. Economist at Oxford Economics, thanks so much for being with us.
Thank you. It was a pleasure.
All right, so that was our interview with Gregory Daco. I always call him Greg, but I know professionally he likes to be known as Gregory. So Gregory Daco, Chief U.S. Economist at Oxford Economics. This is why we need economists, Dan.
This is why we need them, to make sense of it all.
Yeah. What's really interesting, too, and I know you have a lot that you want to say about Bitcoin, so we're going to get into that, which is going to be very exciting. But I think, too, as we move into things like Bitcoin, right, which really you can't do fundamental analysis of Bitcoin because, like, it doesn't go up because of the impeachment or down. It just kind of moves.
And that's a part of my rant later, but basically I've been asking people who are investing in it, well, why are you investing in this? And I think the general consensus is that not that it's some great technology that, oh, it's going up 1,000%. I mean, you got to get in now. So even if it's a total crock, which I do believe it is, which I'll talk about in a minute, people just don't care. They just think it's going up. They can go up and make money now. Then hey,
Well, wait, so I will say this. There is a fundamental case for Bitcoin. I don't want to say that there's no fundamentals behind it. There's no fundamentals, I think, on a day-to-day basis. Like, at Axios, we've been having meetings about, what do we want to do with our Bitcoin coverage? How are we going to cover it? Because it is a thing that lots of people want to know about. They're talking about. When you write a Bitcoin story, you can get a lot of clicks, and there's a lot of interest in things like that.
Right.
And so I think from a fundamental perspective, the reason people are interested in Bitcoin is because they think everything is falling apart and going to shit, more or less. So the idea is like fiat currency isn't going to be worth anything, that like inflation is going to take hold, that, these things that we've normally held, like, just the dollar and the euro and things like that, are not going to represent value the way they did. And you want to have an asset like Bitcoin that's not able to be manipulated by central banks, that's not able to be manipulated by governments when they do stimulus and things like that. It's on the blockchain, you know where it came from.
Right.
It was created by, guys mostly in China, but also a little in Russia and maybe a little here. And there's a finite supply of it. And you can't just the way the Fed just magically created $3 trillion in March, you can't just magically create 3 trillion Bitcoin.
Right.
So that's the attractiveness fundamentally of it. Is just I think people are worried and they don't trust institutions. I went on this rant before, and you can listen to our previous show where I talk about that. But that's the fundamental case of Bitcoin, is that everything is going to hell and that you want to hold this thing that no one can manipulate, that is only controlled by what people who are investing in the market think it's worth. So that's the fundamental case. It does have one. It's just on a day-to-day basis. Like, Bitcoin dropped 10% the other day. Why? No one knows.
Why?
It's like what.
It's
what
also
am I
up
gonna say?
like 500% or something. So it's like
it's up. It's up. I think about 310%. At least last I checked, it's up around 300% from where it was a year ago. So. Yeah, it's a little crazy, but you've got some things you want to say, Dan, and I want to let you say.
I read this article. Listen, feel free to memorialize this. I could watch this in 20 years and be mortified. It's a crock of shit. I'm sorry. I don't care. Maybe I'm if
okay,
I'm
so
wrong
before you get into it, actually, I want to read something.
Please, yeah.
So Britain's top financial services regulator, the Financial Conduct Authority, they put out a warning. They sent it out widely. It's, the Financial Conduct Authority, basically their SEC or maybe their OCC, whoever it is, but the body that governs financial assets. They sent out this warning, and it says, and I quote, "The FCA is aware that some firms are offering investments in crypto assets or lending are investments linked to crypto assets that promise high returns. Investing in crypto assets or investing in lending linked to them generally involves taking very high risks with investors' money. If consumers invest in these types of product, they should be prepared to lose all their money."
Wow.
I just
there you go.
But also that is true, though. You should be prepared to lose all your money.
Right.
And if you're going to invest, you really should be prepared to lose all your money. That doesn't mean I'm not saying it's a crock like you are, but if you are investing in Bitcoin, you should absolutely be prepared to lose all of your money.
Right. And
that should be part of the thesis.
Check the article from the New York Times today about how people have forgotten their password who did Bitcoin like 10 years ago when it was like much smaller. Right. And so now apparently there's like millions of dollars sitting in these accounts that are unclaimed. So I was thinking about, you and I could start a business where we, help people somehow remember their password, and we take half,
Like Inception?
Yeah, exactly. Yeah, we'll do like some hypnotist, or we'll like brainstorm with them. Like, all right, what was your first cat's name? Come on,
I'm sure most of these people, their password is like some 26-digit randomized thing.
Yeah, right.
Or like. Because I constantly forget my password for things, and then I got to do the thing where they send me the email.
Right.
I got to come up with a new password. I cannot imagine. I know the story you're talking about, and this guy was on like attempt 8 out of 10, and after 10 it locks forever.
Yeah,
and he can never access it.
I want to be there. Like, it's like a movie or something. It's like, all right, try number 7. Here we go. It's like, And also, what an awkward conversation that would be to have with like your wife or something. Like, honey, great news. We got got 100 million in the bank. I just, was it
Gotta
Fluffy
get it.
1030 or Fluffy 1044? I don't know.
Right? Is with the capital F or
The capital F, capital, it's a shame. I don't know. It's like you need to have a bank you can call to be like, hey, I'm so-and-so. Please reset my credentials. Like this whole 10 and then it's gone forever. And then where does it go? It's a crock. I'm sorry. It's an absolute
But that's
crock.
that's part of the appeal of it, is that like the bank can't be the one that decides to give you access or not.
Right, that's
You
the
either
whole
just
thing, is that
have
there is
your
no
access.
central bank. Who do you call?
Yeah.
Nobody. You can't call anybody. It's
Who you gonna call? Nobody.
nobody. Yeah, but now there's like other coins. There's like Ethereum. There's Bitcoin. There's like, so it's like you don't even know what coin to invest in. How do you mine it? That's what I don't understand. It's just it's a crock. But yeah, what do I know?
This will be good. Yeah, I mean, right? Well, you look foolish already because it's at like $30,000.
I know, I do. I totally do. And, and it could be in 10 years, this is like the way that we're paying for everything with Bitcoin, and I'll be laughing at myself. But, so.
Yeah, you'll be like that guy who's like, internet? Well, that's stupid.
Right. Well, that's the thing. These Bitcoin people put you in that category. They're like,
They do,
it's a human rights issue. It's a, be on the right side of history. And it's like, It's kind of like people who are marijuana advocates. They call themselves activists. And it's like, it's like, like Rosa Parks was an activist. You know what I mean? Like, you want to get pot legalized. That's a little bit of, not saying it shouldn't be, but, just,
Right.
I'm an activist.
Right. It's a bit. You don't like the label, is what you're saying.
Yeah, exactly. Yeah, right.
Yeah. And look, this conversation is only happening because Bitcoin is at like $33,000 or $34,000 or $35,000 a coin, and so now everybody thinks they can get rich, right? Like it's not like people are really enthusiastic, or at least the groundswell of interest in Bitcoin has happened because people are really trying to be on the cutting edge of the new wave of finance.
Right.
It's because they want to get rich. They want to get rich
But that's what I'm saying. That's exactly what it is. That's the only reason. There's like, it's not like, I mean, I guess to make an analogy of like, Apple. I'm going to invest in Apple. Why? Because I have an iPad and you have an iPad, and these products are amazing. Or I'm going to invest in Sony because I use the PlayStation or something like that. It's like they don't even use the stuff. It's like they can't pay for it anymore. Like where would you even pay to use the Bitcoin? It's absurd.
So look, that's the other thing though. There is now a use case where you can pay people with Bitcoin, I think via PayPal and Square.
I saw PayPal. Yeah.
Yeah, but so that I'm really interested to see what they do with that, because like the value of Bitcoin changes so much. It's always trading, and it moves so much that it's like if I agree to sell you something for like 0.1 Bitcoin, thinking that that's going to be $300, and then by the time you actually make the payment, it's now $200. Like that sucks for me.
Yeah. How does that work? I didn't even think about that. How does that work?
I don't know why you'd want to do that. I don't know why anyone would want to do that, because the volatility on Bitcoin is just incredible. And I think, and it's not a thing that you can really fix. It's sort of part of the bull case, or part of the attractiveness of it, is that it moves so much and that it's had these just crazy moves. And that's why people are so into it, but it also just kind of destroys the use case of it.
Right.
So anyway, all right, are you done ranting? Is that
I'm done. Good? Yeah, it's going to do it for me.
All right. That's going to do it for the show.
Yeah.
We're gonna keep it short and sweet today. Thanks for being with us on Market Banter. I'm Dion Rabowen, financial journalist. Please, if you haven't signed up for the Axios Markets newsletter, that's Dan Enfield, New York City's legendary comedian. Dan, you got anything you want to plug?
No comedy right now. Once this comedy opens back up, everybody will be the first to know.
All right. Well, when comedy comes back up, we'll let everybody know right here on the Market Banter podcast.
Right here.
Thanks for tuning in.